Yesterday it collapsed into the close. It's one of those times when the market was racing down toward a support level on the higher time frame chart. On the daily chart, it was testing the December 20th higher low. I think that's a minor higher low, even though it led to a very strong rally. It's important that yesterday's low held above this. This was the start of a very strong rally. The bulls are hoping that this sell-off is just a wedge bull flag, 3 legs down, 1, 2, and 3, forming a double bottom higher low. So they're hoping this is a pullback from that. The market's been in a trading range for 3 months. We raced up strongly to a new top of the range, reversed down, and we sold off strongly down to the bottom of the range. I suspect we're going to bounce around where we are. We might go below the December low and then bounce, but I think we'll bounce. And how high up? Maybe this area, right? That was resistance, broke above it, it failed. Resistance again, sold off. So we may end up forming a big head and shoulders top. So like left shoulder, head, and then over the next couple of months, a right shoulder, and then try to break below that and get down to that October low. We're just above the December low, the December 3rd low, which is the low of December. And if we were to go below it in the next couple of weeks, here's the monthly chart, then December would be upside down. January would be upside down. We went above the December high. If we go below the December low on the monthly chart, we'll have consecutive outside bars like we had here. Here we had a bull breakout. If we get consecutive OO patterns and a reversal down, I think we'll probably trade down for a few months down to the area of that October low here. And there's this gap here just below 4,000 on the monthly chart. And I think that's the worst case scenario for the year. So if Trump invades Ukraine and it becomes a big mess, maybe we'll go down below 4,000. We had a sell climax yesterday, and the day after a sell climax, 75% of the time has at least a couple hours of sideways to up trading. And we've already retraced to the top of the most recent sell climax here. You could argue this is also the top of the sell climax. Might get there. We broke below last week's low on the weekly chart, and it looks like the market wants to get there. It wants to get to the top of this final leg down, little parabolic wedge, 1, pause, 2, pause, 3. So I'll make it a couple legs up to here. Yesterday was a very big day on the daily chart. That increases the chances that today will be an inside day. So if we do sell off, there might be buyers just above yesterday's low. And if we rally, there might be sellers just above yesterday's high, so just below yesterday's high. So today's range probably is going to stay within yesterday's range. It's possible that we collapse again below this low and get down here, but look at the screen. This is the daily chart. It's sideways for 3 months, and reversals are much more common than successful breakouts. We break out and fail, reverse down and fail, tried to break out, failed, tried to break to the downside, failed, broke to the upside, it failed, tried to break to the downside, well, it's probably going to fail. So we're going to bounce from where we are, or it's possible that we could break below the December low, but we're at the bottom of a trading range, so chances are we're going to bounce at least for a day or two. Here we bounce for a couple of days and then get another leg down. This is an important target, a breakout point. We have a breakout point here, did not overlap. We have a breakout point here. I suspect that will overlap it, and that's last week's low. We're in a trading range, and therefore traders betting against breakouts typically make money. So some institutions that bought that low, well, they already made some money, but they bought that low, we broke below it. We should come up back above that low, which is last week's low. And that's right there. It doesn't have to be today, but today or tomorrow, we'll probably get back above that low. Also, on the weekly chart, we're breaking below the bottom of a bull channel, but we have a possible double bottom bull flag with that December low. So you can see we might bounce and form some symmetry, possible head and shoulders top, left shoulder, head, and then bounce for several weeks and try to form the right shoulder. So a very big first bar, but a big tail on top. And bulls are not going to want to buy above 1. And for the bears, they're hoping it's another lower high in the bear channel. We had a series of lower highs yesterday, here, here, and they're hoping this is another lower high and that we sell off like we did here and like we did here. I think we'll probably go below 1. I don't know, maybe in the first several bars. But as I said, I think we'll probably hold above yesterday's low and try to remain an inside day. What do you do right here? You wait. More information. You need more bars. We just broke above the Globex high, and we have a trading range for 6 hours or so. We broke above it. We may come down and test the bottom of it, which is 45.30, and that is over here. It's above yesterday's low. Now, what about selling below 2? If it's a bear bar closing near its low, a lower high in a bear channel, another failure at the moving average, possible high of the day. That is all true, but that is a big gap up, and that is a pretty good sized bull body, and that will reduce the number of bears willing to sell below 2. They might want to wait for a micro double top. Suppose 2 is a very good bear bar closing on its low. It's still probably going to be a minor reversal down. Magnet below yesterday's close, yesterday's low, the January 10th low, and less likely all the way down to the December low. So you will get bears taking a chance if 2 closes on its low. But if it's anything less than perfect, I think most traders will wait to see if we get 2 or 3 bear bars and then sell. And for the bulls, they're hoping the gap up and 1 are the start of a bull trend. And 2 then is a high 1 buy signal bar. But with that big tail on the top of 1, I think you'll get fewer bulls willing to buy above 2. Bears trying to get 2 to close on its low, that will attract some sellers. Bulls trying to get a big bull bar closing on its high, but that is unlikely. But even then, as I said, with that big tail on the top of 1 and the big gap up, I think a lot of bulls will not buy above 2. So it looks like we're probably getting a trading range open. We're in the middle of this big sell climax from yesterday. Traders will probably buy somewhere below and sell somewhere above. So a bad signal bar for the bulls and for the bears. So probably sellers not far above 2 and 1. Probably buyers not too far below 2 and 1. Better to wait. One of the admins told me that there was a problem with the website this morning. So I have been talking and nobody has been in the chat room. He was able to fix the problem and everybody will start coming in. I'll wait for more people before I go back over everything I said for the first 10 minutes. For the bulls, we have a reversal up, a pullback, a high 1. Last week's low was a magnet above. Obviously, the top of the sell climax is a magnet above as well. Today might be an inside day. Yesterday's range was huge, but it was simply a self-vacuum test of the bottom of the 3-month trading range, and the market's reversing up. So do you buy above 3? Well, this is a pretty big move up here. It's not far above the moving average, but it's still a pretty big move up. It's probably better to wait to see if we get consecutive bull bars before buying too high. We're right in the middle of yesterday's range right now, almost exactly in the middle of yesterday's range. And we're back here where the market was sideways and here where the market was sideways. This is an obvious target, the top of the most recent sell climax. And last week's low is important as well. It's also at the 20-week moving average. All right, so we have 2 bull bars, but they're not consecutive. And a lot of the bulls would like to see consecutive bull bars. Best choice right here, flat. Can you buy it at the market and put a stop below yesterday's low, betting we're not going below yesterday's low today? That's too much risk. Big down, big up typically creates confusion, and that increases the chances we'll have a trading range open. The tail on top of 1 and the bear bar 2 with prominent tails further increase the chance of a trading range open. Bulls trying to get consecutive bull bars, and then they want the rally to go up to the next resistance levels, the 70 high, the top of the most recent sell climax, and last week's low, possibly the 60-minute moving average. Everything is big. The bars are big, the legs are big. So if you're trading when the market is like this, you have to trade very small. Like 20% size. I talk about how it's good to have 2 sizes to choose from. Your normal size, which you trade on most of the time, and then a second, much smaller size that you trade when the bars are big and you're afraid to take positions because of risk. It's better not to have 5 different smaller sizes. You want as few decisions as possible when trading. So the example I give is if your normal size is 1 E-mini, the smaller size should be maybe 20% of that, 2 micro E-minis. Can you see a wedge here, a wedge rally to a double top? If we get a reversal of 4 or 5, we'll have a double top, and a wedge would be 3 legs up, 1 pullback, 2 pullback, 3. So this is a wedge. Very often, a wedge rally will begin before the bear trend has ended. The market is usually transitions from up to down, down to up, and a lot of times the beginning of the bull trend begins before the bear trend ends, and the beginning of the bear trend begins before the bull trend ends. Yesterday, a wedge here, 1, 2, and 3, and the start of the wedge rally began before the bear trend ended. As more and more of you come into the room, I'm going to repeat things that I said earlier. I talked a lot nonstop for the first 10 minutes, but nobody who was in the room, I didn't realize that there was a problem with the website. The most important thing that I said was a very strong sell-off, but this is the daily chart. Look to the left. We're at the bottom of a 3-month trading range. And at this price, we rallied. So I think we're going to rally. It might be just for a day or two, and maybe we'll break below successfully. But it's still a very strong, it's still a trading range. And very strong rallies reverse down like this and like that. And very strong sell-offs reverse up like this and like that. So chances are we're going to bounce, at least for a day or two. Also, yesterday was a sell climax day. 75% of the time, the day after a sell climax day, we'll have at least a couple hours of sideways to up trading. And we're up right now. So big down, big up. That generates confusion, and confusion usually results in a trading range. When traders are confused, they don't want to hold on to positions very long. They get a profit, they take it. Also, they don't want to buy high because they're expecting reversals. They don't want to sell low, they're expecting reversals. So they buy low, sell high, and take quick profits, and the result is a trading range. Bulls will try to get a higher low major trend reversal, which would be a head and shoulders bottom, left shoulder head, and then if we sell off for 5 bars or so, maybe get a right shoulder. Right now, we're always in long. We have consecutive bull bars, 3, 4, with one of them being big and closing near its high. So it's a buy the close market. But stop would be below 3 or below 1. That's more than $1,000 per E-mini contract. So if you do buy at the market or at the close of 4 or above 4, you need a wide stop. Can you sell at the market betting on double top 70? Well, we're always in long, and the first reversal down probably would be minor. So it's probably better not to be selling. Today is probably going to be an inside day. We're probably not going below yesterday's low, and we're probably not going above yesterday's high, way up there. That's too far up for the market to get there. This is too far down right now for the market to get there. So today's probably going to be an inside day, which is fairly common when yesterday was a big day. Remember the other day I talked about how Monday was a holiday and that they would remove it, and it was a tiny doji bar over here. Well, they finally removed it. So on the daily chart, there was a bar here, a little doji bar for Monday, and I said they removed it. They removed it on Wednesday morning or overnight Tuesday night, which is a long time, but they always remove those holidays. Bears want double top 70, and but they'll probably get a minor reversal. Wedge 1, 2, 3 might come down to the moving average, maybe to this low and that low. All right, but if we do, the bulls will look for a higher low, a cup and handle. We have a climactic reversal, big sell climax and a big reversal up, and if we get a pullback, it typically will lead to a second leg up, and the pullback is usually a higher low major trend reversal. In this case, it would be a head and shoulders bottom. It's still by the close by the market, but I think the odds are we're going to pull back before we go much higher. Yesterday, we ended with 3 consecutive inside bars, I, and we broke to the upside. Yesterday's low was just above the January 10th low, and the reason that's important is that January 10th, I'm sorry, the December 20th low, I had that wrong. The reason that's important is over here in the daily chart, we had an extremely strong rally, and now yesterday's low was simply a sell vacuum test of that low. Yesterday's low did not go below that low. The bulls are hoping that this is just a higher low double bottom, a test of that low, and then it's a wedge, 3 legs down, 1 pullback, 2 pullback, 3. So a wedge sell off to a double bottom, and they hope the bull trend resumes. I do think we're going to bounce either from where we are, maybe from around the December low, maybe a little bit below, a little bit above, but I think we'll have a hard time getting above this level. Resistance, broke above it, it failed, resistance. And I think what might happen is over the next month or so, rally up in here and form a lower high. So big head and shoulder stop, left shoulder, head, and then rally for a month or so and form a right shoulder, and then get down here at some point in the first half of the year. Getting back above last week's low, and the 20-week moving average, weekly chart, 20-week moving average, bottom of the bull channel, but also the bottom of a 3-month trading range. So yeah, we broke below the trend line, but we're also at the bottom of a 3-month trading range. Trading range breakouts are less common than reversals, so you have to assume we're going to bounce. Why did we collapse yesterday? There's always news, and the news reporters always blame every big move on the news. And the real reason is technical. We're just testing the bottom of the trading range. And here's a 15-minute chart. We're testing at December 20th low, extremely strong rally. Retraced almost all of it, but yesterday's low did not drop below that. It held just a little bit above it. So a sell vacuum test of yesterday's low. Still buy the close, right? And get out several points below any bar, or 1 tick below a bear bar. The bulls have bought above above 4, reasonable to buy if you trade small. Their stop was maybe below 4, so they want a measure to move up here, which is a test of the 60-minute moving average, back above last week's low. Daily chart, we're also testing the 100-day moving average. We dipped below it here for about a month and then rallied, got near it, and finally broke below it this week. And the bulls are trying to get a reversal up. I'm going to get rid of that. But next target, the 60-minute moving average and the top of that entire sell-off from yesterday. Possible cup and handle bottom. Where you have a sell climax and a very sharp reversal up. A bull surprise, the rally. You expect at least a second leg up. So traders will buy the first pullback. And some people call that the handle of a cup and handle bottom. It's also a higher low major trend reversal. And it's often a head and shoulders bottom. Sell climax and very strong reversal. Traders buy the first pullback, expecting at least a small second leg up. So the sell climax and the strong reversal, the cup, and the pullback is the handle. It's often a head and shoulders bottom. So you got a sell climax and a very strong reversal. Traders buy the first pullback. Sometimes the first pullback is just a few bars. Sometimes it's 20 or more bars. But traders will look to buy the first pullback, looking for at least a small second leg up. Here they got a bull trend, a major trend reversal. Sell climax, very strong reversal, and then pullback. Not much follow through buying, but it's still a cup and handle. Here it's a 2-bar pattern, so sell climax and reversal. On a smaller time frame chart, it might be 20 bars, 30 bars, depending on how small the time frame is. And traders buy the first pullback here or here, and they got follow through. Sell climax, very strong reversal. Sideways for a couple of hours, but that is the handle. This is the cup. Different shapes. Sell climax, strong reversal. Traders buy the first pullback, looking for at least a small second leg up. Sell climax, reversal. An attempt at a handle. It grew into a bigger one, and then we got a second leg up. Do we have to get that today? No, but that's usually what happens. When you get a very strong rally like this, you expect a second leg up. So traders will buy the first sell-off, and it'll form a higher low. Higher low, major trend reversal, head and shoulders bottom in this case, because we have a left shoulder here. Can you sell below 7? Arguing we're going to get a pullback. The rally is big. The pullback might be all the way down here, might be 20 points or more. And therefore you could sell the reversal down to the pullback and then buy the pullback. If we go sideways and get some kind of a micro double top, you might be able to sell that. But chances are traders are going to buy the first pullback. Is bar 1 the low of the day? Well, this is bar 7. By the close of bar 7, there's a 50% chance we've seen either the high or low of the day. By the close of bar 12, there's a 70% chance we've seen either the high or low. Market often has a 50% pullback, so let's say we start to pull back here. 50% is here around these lows. The market often tests prior lows, so we might come down there and test that. For the bulls, it's a high 1 or a third leg up. First leg up, a bull bar and a gap, pause. Second leg up, pause. Third leg, probably sellers not far above 7. Now, can you sell below 7? A higher high double top, 70. Lower high double top, 42. It's a 7-bar bull microchannel. That's a low probability sell. What happens if 8 is a big bear bar closing on its low? Then we will have consecutive big bear bars with one of them being big and closing on its low. That typically is a sell to close situation, but I would still wait for more. We have a 7-bar bull microchannel. Traders typically buy the first reversal, so I suspect there are more buyers than sellers at the 7 low. But if we do go up, let's say 8 is a high 1, then we'll have a new version of a parabolic wedge, 1, 2, and 3. And as I said, I think we're probably going to stall. If we go straight up to the 60-minute moving average and this high, we'll probably stall there and pull back. Pull back for 5 bars, 10 bars. Bears trying to get a credible sell. They'd like to get a second consecutive bear bar, preferably with a big body closing on its low. Maybe we'll come down to the 1 high, the moving average, the 4 low. We have a breakout 3 and then tail. So on a smaller time frame, this is probably a spike in the channel up. The start of the channel is a magnet, the 4 low. It's around the breakout point, the 1 high, and around the moving average. Now, what about bulls who buy the 7 low? If they can use the wide stop and scale in, they'll probably make money. Do you sense the confusion? Look at yesterday at this price. What did we do? Well, we were there for several hours, 4 or 5 hours, in a trading range, and we're in the middle of that range. The bottom of the range is down here, so it's possible that we'll come down there. Top of the range is here, and the 60-minute moving average is there. Bull's trying to get a high 1.8, and I don't like to buy third legs up when there's a possible parabolic wedge at resistance, and therefore I'm probably not going to buy 8. If it closes on its high, I might buy, but I don't think so. Because, well, there's 10 points, but you have to risk 10 points. The bars are 10 points tall. But it's a possible third top. 1, 2, pause, 3. And possible double top at the 60-minute moving average. $60-minute bar. The whole sell-off was just a test of the bottom of this extreme buy climax. If we break below that, then yeah, it was a test, but the test failed. The bulls would not have bought again, and we would get a breakout below this low. So we're testing it, and it looks like a successful test. If we break below, it's a failed test and a breakout. Very strong rally, a target. So over the next week or so, we may get back up here. High 1, but a doji and the third leg up. So I'll let somebody else buy that. I'm not going to buy that. Remember, we were sideways here for 5 hours, and we're right in the middle of it. So we may come down and test the bottom of it again. Best choice right here. I think it's reasonable to get out of longs. And for the bears, I think it's not a great short. I think it's a minor reversal. But with everything big, the market could easily pull back 20 or 30 points and still be always in long. When I think the market is probably in a trading range, I typically am looking for quick profits. When the bars are big like this, some of the bars 15 points tall, I'm looking to take at least partial profits at 10 points. So for traders who bought above 3 or 4, it's reasonable to take some profits here, and that's what's causing this. A lot of traders are taking profits. Bulls are trying to get a high 1, and they have it. 7's a high 1, 8, 9, they're all high 1 buys. But 3 bars without a bull body and possible parabolic wedge with 1 and 6 just below the 60-minute moving average. That is reducing the number of stop order bulls, traders willing to buy above 9 with a stop. And the bears do not have a very good sell yet. 3 bars without a bull body, but none of the 3 bars is big, closing on its low. So not a lot of traders willing to sell below 7, 8, or 9. Getting near the end of the first hour, the bulls would like the hour to close with a big bull bar, and they'd like to close above the 60-minute moving average. That's probably not going to happen. It's, I think, too far above for the market to get there in the next 15 minutes. Also, it might get there, but it's unlikely to close very far above it. Nobody wants to buy, right? Too high up, magnets below, and resistance not far above. But not a very good looking sell. Bears trying to get a breakout, a close below something. They're trying to get 10 to close below 9. But is it a short? Well, as I said, this is a small spike in channel rally, one spike pullback channel. Let me take a look at the 1-minute chart. But that's a big bar, and then we have tails, 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 tails. And it's probably a spike in handle on a smaller time frame. Here's a 1-minute chart. So spike and then channel up. Tried to top out, broke out, second leg up. Testing that. I suspect we'll come down and test that, which is here, the bar 4 low and the moving average. Reasonable to be out of longs, but for the bears, I don't think the math is all that good. We're probably going to get a higher low somewhere around the moving average, the 4 low, and down here, 61 low. That would be about a 50% pullback of that. But my general rule is if you get consecutive bear bars, one being big and closing near its low, it's sell to close. So theoretically, if 10 closes near its low, that would qualify as sell to close. I just don't think we're going to go down very far. The bears are hoping it's a double top 70. Some computers will look at it as a lower high double top 42. But 7 bar bull micro channel, bar 7. I'd rather wait to see if we get a higher low around the 4 low and the moving average, and then look to buy that for a second leg up. 4 bars without a bull body, plus a relatively big bear bar. A lot of the bulls will want a micro double bottom, which means several more bars. So whenever you look at the chart and you say, it's messy, it's better to wait, you're probably in a trading range. So despite the strong reversal up, it's still in the middle of yesterday's trading range, and it's starting to do trading range types of things. Bears have a breakout 10, close below 9, but it looks like more traders bought the close of 10 than sold the close of 10. We're still always in long, and most traders are expecting at least a small second leg up. That will reduce the number of traders willing to sell the close of 10. What do you do in a situation like this? You need more information. That means more bars. Wait to see if you get 2 consecutive big bear bars, maybe flipping it to always in short. Bulls trying to get a better high 1. They don't want to buy above 7, 8, 9, or 10. They'd like to get a bull bar closing on its high, maybe 11. But even then, after 4 bars without a bull body, we'll probably get a second leg sideways to down. So anybody buying above 11 probably needs a wide stop to allow for a possible second or third leg down, maybe a wedge bull flag at the 4 low. So best choice here is flat. The bulls would like the first 60-minute bar to be as bullish as possible. They want bar 12 to close at the high of the first hour. And that's part of what's going on here with 11. Bulls are trying to get the hour to close on its high. That would increase the chances that will go higher next hour. So if you buy above 11, I'm not planning to do it, but if you do buy above it, well, I don't know, I was going to say use a wide stop. If you buy above 11, it's probably better to put the stop below 10. I'm going to wait. Failed breakout, high 1, second leg sideways 2 up likely, but we may not be done yet with the pullback from 6. 4 bars without a bull body increases the chances that we'll get a second leg sideways to down before the bull trend resumes. You can sense the uncertainty. Here we have a high 1 after a very strong bull trend reversal, yet it's not racing up. You know, the market raced up to resistance, last week's low, in the middle of yesterday's trading range. It should get to the 60-minute moving average at some point today, but we may get more sideways to down after 4 bars without a bull body. That's the end of the first hour. And we have a big bear bar and then a big bull bar. And the bull bar opened near the open of the bear bar. I talked about that the other day on the daily chart. When that happens, all the bears who sold down here are trapped and they'll be forced to buy back their shorts. And the result usually is some follow through buying. We had the same pattern on the daily chart over here. Friday, big bull bar. Monday, big bear bar. And the opens are near one another. So all the bulls who bought up here are trapped and they have to sell. And usually you'll get some follow through selling. And yesterday was the follow through selling. It's still always in long here, and we should get up to the 60-minute moving average. We don't have to stop there. You know, it's possible that we can retrace all of yesterday, but I think today is going to remain an inside day. We did not get below yesterday's low. I think we're probably not going to get above yesterday's high. Today, I don't think we'll get up there. So, you know, maybe we'll top out somewhere around here. You know, maybe 60-minute moving average, maybe a little bit higher. We've probably seen the low of the day. By the close of bar 12, 70% chance we've seen either the high or low of the day. And at this moment, it's more likely that we've seen the low of the day than it is that we've seen the high of the day. Do we have to stop at the 60-minute moving average? Well, you don't have to, but I suspect that we will, because it's also the start of this sell climax from yesterday. I think a lot of smart traders understand what I said, that despite how strong the sell-off is on the daily chart, we're still at the bottom of a 3-month trading range, and reversals are more common than successful breakouts. So there's an increased chance we're going to bounce here, maybe all the way up to these lower highs over the next couple of weeks. Bears are hoping we've begun a bear trend reversal. They want the bounce to end after a day or two like this and then get another leg down. Possible final bull flag, possible wedge 1, 2, 3 or 1, 2, 3, but 3 bull bars in a pretty strong reversal. The bears will need a very good bear bar or micro double top. We're at, I think, the target zone, 60-minute moving average and this lower high, so I suspect we'll pull back here. What happens if we break strongly above it? Well, then it's possible that today will totally erase yesterday and get above yesterday's high. 60-minute chart, this entire sell-off held above that low. This entire sell-off is right now simply a pullback from this, and the bulls are hoping that we get a double bottom, we break above the neckline, and we go up for a measured move. But more likely, if we do go up, we'll stall out around here where we stalled out back in November and December and early January. So trading range for 3 months. We're at the bottom, and the bulls are trying to do this again, but I don't think they'll do that. We may have to do this for a week or so before we can go up. tail, right? You got some limit order bears who sold the 6 high, sold more higher, betting that the breakout would pull back below the 6 high, which it probably will. And that tail reduces the number of bulls willing to buy the close by the market. It's a sign that a lot of the bulls took some profits right before the bar closed. A lot of the bulls who bought, they took their 10 points. And because of the possible wedge, 69-6 or 1-6, some of the bulls will wait to buy. This might become a wedge with 6, 13, and then who knows, 17 or 18. The market often tries to reverse around bar 18, 16, 17, 18, somewhere in there. So we may get one more leg up before we get more profit taking. When we do reverse, we might get a couple legs down, maybe to the 10 low. Might be 2 or 3 small legs down here. High 1, 15, 14, but probably we're probably going to fail to break strongly above the resistance. We're probably going to fail to break strongly above the resistance. That high 60-minute moving average might get a little bit above it, but I think we're probably going to start to pull back within the next few bars, maybe around 16, 17, or 18. I said starting with 16, this is 15. Also, it's not a bear bar closing near its low. It's less likely to be the short of it, but I would get out of longs below 15 or a couple points below 15. And for the bears, because it's not clear, if you do short below 15, it's probably better to use a pretty wide stop. I think it's probably better not to short. At least not until we start to see some bear bars. We're testing resistance. I think we'll probably pull back here, but bulls trying to get the breakout, and they're trying to totally undo yesterday's sell-off. They're trying to get above yesterday's high. But I suspect we're going to pull back here or soon. We might have to stop going up, go sideways for several bars before we pull back. And for the bulls, strong bull trend. We're up 70 points from yesterday's low. While it's still, by for any reason, currently flat, I think we'll probably pull back from this resistance. Bulls obviously do not want that. They want to successfully break above the resistance and then go up to that next cluster of resistance up here. "15-minute chart. We got that high. We got yesterday's high, and we have the open of the week. They're hoping, 60-minute chart, they're hoping that this whole thing, I'll put up a 4-hour chart. They're hoping this whole sell-off is simply a test of the bottom of that buy climax. What about shorting right here at the market at the 42 high, betting on a pullback at the resistance of the 42 high and the 60-minute moving average? I think the math is probably okay, but I think most traders should not do that. I think they should wait for one or more bear bars. This could be a successful breakout above the resistance and continue a lot higher. The reason I don't think that will happen, the reason why I think we will pull back, we have selling here, we have tails here. So, and then 60-minute moving average. It's usually pretty reliable support and resistance, and we've been below it for 20 or more bars. So I think, plus we're at the top of a 2 or 3 day trading range, 2-day trading range. So I suspect that we'll stall here, like we did here and here and here. Wedge now is 6, 13, 17, but 7 bars without a bear body, that will reduce the number of bears selling below 17. Bulls, they can get out below a bear bar. They can get out 3, 4, 5 points below a bull bar. It's a wedge. The market often comes all the way back down to the start of the wedge, the 10 low. Usually you get a couple legs down before the bulls will start to buy again. That's if we get the reversal, which I think we will. When there's a rally and then a bear bar around bar 18, it's usually good for bulls to get out. And some bears might sell if 18 closes near its low, hoping that we'll get a couple legs sideways to down. But sometimes you just go sideways. Pretty good rally, but if you get a bear bar around, well, here's bar 18. We broke above the 18 bar range and failed. Let me go up here. This is what I want. If you get a bear bar around bar 18, bear bar closing near its low, in a rally, you're probably going to get a pullback. Sometimes it's big enough for a swing down. Bear bar here, and then a second bear bar here, around bar 18. Here we broke out of the 18 bar range. This is bar 18, but we broke out of the 18 bar range and got a bear bar. Here's the 18 bar range, broke out above, got a bear bar. The blue box is the 18 bar range, got a bear bar. So some traders would sell below that, looking for a trade down. Here we tried to break above that range, reverse down. Traders will sell the failed breakout. Breakout above, bear bar. Traders will sell, betting on at least a pullback. High one, but bear bar at resistance, and the rally is not all that strong. The bulls are hoping that it's a small pullback bull trend that will last all day, but I think we're going to pull back. Next resistance is the open of the week, 4,600, big round number, and yesterday's high. We were very close to yesterday's high. We still might get there, but remember early on, well, like nobody was in here for the first 10 minutes, but one of the things I said is that today had a good chance of being an inside day, so that traders would buy above yesterday's low and sell below yesterday's high. Can this continue all day? Small pullback bull trend? Probably not. I think it's going too far, too fast. And just like we collapsed yesterday and stopped going down, we're doing the exact opposite here. I do not think we're going to get a bear trend today. But what tends to happen when you go up really, really fast up to key resistance, the market usually ends up going sideways. And it reaches its target and then stops going up. Bull trend from the open and then a trading range. Very, very common pattern. The market races up and then goes sideways. Extremely strong rally, reaches some resistance level, and then just goes sideways for the rest of the day. Very strong rally, sideways. Here we got some trend resumption up at the end of the day, but I think we're going to soon start to go sideways. We went up for more than half the day, but the trading range began over here before the bull trend ended. The market often has transitions where the next phase begins before the current phase ends. So the bull trend ended here, but the trading range began before the bull trend ended. You can see we tested down to here, tested down to there again. So when you look at this and say, where does the trading range begin? You would say that. You could say this is the start of the trading range, the end of the bull trend. I would say the start of the trading range was here, and it began before the bull trend ended. Trading range for a couple of hours, tried to get some trend resumption up. But this is what I think we're going to do. Lots of variations. Bulls hope to get trend resumption up later in the day, or they hope that if it's a trading range, it's also a bull channel. We keep working higher, but some kind of a trading range is likely today, or they hope that if it's a trading range, it's also a bull channel. We keep working higher, but some kind of a trading range is likely. How much higher do we go before we enter the trading range? Who knows, right? But I do think we're going to stall around the 60-minute moving average and that high. And now we have a parabolic wedge, 1, 2, 3, and a spike pullback channel. So this is certainly a good location. The context is good for the start of a trading range that could last for the rest of the day. I would get out of longs below any bear bar. And for the bears, they'll probably start selling because the channel is tight. The bears who are selling, the first bears will probably use wide stops and scale in. And stop order bears probably will wait. Well, they might sell below 20 because of the parabolic wedge, 13, 17 at resistance. So, but I think it's going to be a minor reversal. I don't think we're going to get a trend reversal down to the 10 low. I think it'll be a trading range. The bottom of the range might be around here, maybe the moving average. The bulls are hoping that this is a small pullback bull trend that lasts all day. That we just keep going up and up and up. We keep forming wedge tops and parabolic wedge tops. We pause here for an hour, but we just keep going up. Different ways to look at parabolic wedges. Strong trends are constantly forming wedges, yet the pullbacks remain small and the bull trend resumes. This is what the bulls are hoping will happen, that we just keep going up and up and up. But given that we sold off so strongly over the past couple of weeks, and now we're at a resistance area, I think we're going to stop going up around where we are. And I don't think we'll go, if we do go down, I don't think we'll go down much. The bears shorting below 20 are hoping for a bear trend. They know they probably will not get it, and they'll end up scalping out. They're hoping for a big bear bar. They're hoping for a bar like 782. They know they're probably not going to get it, and then they'll switch to scalping, try to get out with 5 or 10 points. Can you hold long below a bear bar? I would not. I'd get out. You can always buy again if you get a bull bar 21 or 22. 21 is a multiple of 3. If it closes near its low, then the 15-minute bar will close near its low as well. There's the 15-minute Globex chart. You can see it's a higher high double top with this. This is yesterday's high. It's a lower high double top with that. Possible parabolic wedge, 1, 2, 3. Bulls, I'd get out below a bear bar. If I'm trading the 15-minute chart, I'd get out below that. Reasonable short, spike pullback channel, 1 pullback, 2 pullback, 3. Those tails represent a high and a pullback, high and a pullback. And we have 3 of them, and it corresponds to the wedge that we have right here, 1, 2, and 3. I did sell below 20. I took part off right here at 5 points. And I'm holding part just in case we collapse, but I don't think we will. So I'm going to be pretty quick to get out the balance. Bulls are hoping that 21 will be like 10, that we get a bull bar for a high one on the next bar. But what's different here is we're at, I think, significant resistance, the 60-minute moving average in the top of yesterday's sell climax. And we have a spike in channel rally, spike, pullback, and then 3 legs up. So we'll probably get a couple legs sideways to down before bulls will be willing to buy again. So I'm not looking to buy above 22. And how far down do I think it'll go? I don't know. I think we'll probably get a couple legs sideways to down. And I think a trading range is more likely than anything. 22, 21 closed near its low. So it corresponds to the 15-minute bar. And here's the 15-minute bar. So the bear's a double top. And this has been resistance for 3 days now. And it's a low 2, low 1, low 2. So we'll probably go below that low and trigger the sell. But I think the bears will have a hard time going below these lows. And right now, I do not think we'll get down that far. I think more likely, maybe we'll get to the 14 low. I don't think we'll come all the way down to these lows. You know, possible we get all the way down here, but somewhere between the 14 low and here, 14 low is probably more like it. 6 high, the breakout point, 14 low, moving average. Consecutive bear bars, one big and closing near its low. So that will attract more sellers. Some traders will want to see a bear follow through bar 22, but a trading range is more likely than a bear trend. And, you know, I don't want to be selling too low in a trading range. You know, if you get a big bear bar in a trading range or in a bull trend, you'll get more traders buying than selling. They'll say, wow, that's a gift, more profit than what I was expecting. Maybe I'll take some profits, buy back my shorts. The bulls will look at it and say, oh, it's a small pullback bull trend, and therefore anything bearish is going to fail. And they see a bear bar and they buy the close, bar 10, bar 21. But this is different. We're at important resistance and we're stalling. And we have a parabolic wedge. So I think we'll probably get a couple legs sideways to down. The bulls are trying to prevent 22 from going below 21 because 21 is the bottom of that 15-minute bar, and 15-minute bulls will exit. If you're trading the 15-minute chart, you're going to exit below that 15-minute bear bar. So the bulls are buying the market, trying to prevent the market from trading below that 15-minute bar, because they know if it goes below that, a lot of bulls will start to take profits and maybe we'll go down for several bars. Also, it triggers a sell for the bears, a higher high double top. So bulls are buying, trying to prevent the market from going below that 15-minute bar. Back to the 5-minute chart. That's a 10-bar exponential moving average. And sometimes when I'm scalping, I'll use that as a guide for buying. So I'll pull back to the 10-bar moving average, bull bar closing near its high, it's a buy. Pull back to the 10-bar exponential moving average. If this bar closes near its high, it would be another buy, except that we have a parabolic wedge and a spike pullback channel at resistance. So increased chance we're going to get a couple legs sideways to down. We're going to get a couple legs sideways to down. I got to change something here. Can you buy above 22? Yeah, I'm not going to. You know, I might buy back my remaining shorts if it closes near its high. Otherwise, I'll keep a stop above 19 and see if we get a second leg sideways to down. But I'm willing to buy, but I'd like a couple legs sideways to down before buying again. It shows triggered the sell on the 15-minute chart. Actually, the last bar, 22 triggered the sell. And bears are hoping for a bear trend reversal, but they're probably not going to get it. It's probably going to be a minor reversal. Bears trying to get a breakout. A breakout is just a bear bar closing near its low and closing below something, at a minimum, the low of the prior bar. And if we do get the breakout, one target would be a measured move down, which would be down there. Again, I don't know how far down we go, but this whole thing might have been simply a buy vacuum test of resistance, just like this entire thing yesterday was simply a sell vacuum test of support, the December 20th low. Now, am I willing to add my shorts back on? I took half off at 5 points. Am I willing to start to build up the short position? No, I think it's probably going to be a minor reversal. What happens if we get 2 or 3 consecutive big bear bars? Well, then it could be a major reversal, but I still think we've seen the low of the day. I think the best the bears will get is a test of that 10 low. I doubt we'll come all the way down here in the low of the day. A breakout attempt, but close at 22 low, not below 22 low, and not on the low of the bar. So this is consistent with what I have been saying, that we're probably going to enter a trading range. And this is probably a bear leg and a developing trading range instead of the start of a bear trend. I'm back to flat. I get out right around the close of 23. For the bulls, it's a wedge bull flag. Do you see the wedge? 18.21. So the first leg down of the wedge began before the bull trend ended, 19. However, I think, I said I thought we would get a couple legs sideways to down from the wedge. And we have 2 legs down, 21, 23. But is that enough bars to correct this much buying? Probably not. So I think if we go up above 24, it probably will be a minor reversal up to a lower high, and then we'll get a second leg sideways to down. So the math right now is difficult. Bears who sold below 20, they made good profit in a bull trend, and I think a lot of them, will take their profits and wait for the next trade. And for the bulls, we have a gap, 23 low, 16 high. They hope for a measured move up, but we're stalling at resistance, 42 high, 60-minute moving average. I think we'll probably get a couple legs sideways to down. So, can you buy above 24? Well, it's still always in long, but I would rather wait to see if we get 2 or 3 bull bars and then buy, or wait for it to go sideways to down for a couple legs and then buy. But this is a good example of if you're selling in a bear trend and you have a reasonable sell signal. If you're selling in a bull trend and you have a reasonable sell signal and you're expecting a minor reversal, don't hold hoping for a major reversal. Take profits. I wanted to get 10 points on the balance of my position selling below 20, but it fell 9 points and then we got that tail. So that made me think that a lot of traders were trying to buy at 10 points. Some of the traders were bears who sold below 20, looking to buy back shorts, and others were bulls betting that the bears would buy back shorts and betting that there would be a lot of scale-in bulls buying 10 points below 20, 20 points below 20, betting that we'll get back to the 20 low and they could get out with a 10-point profit. Now 24, a multiple of 3, so it corresponds to the close of a 15-minute bar, and it's closing on its high, so it's a high one buy. You can see on the 15-minute chart down here, we have a top, but now we have a high one bull flag. Even based on the 15-minute chart, I would not take that. It still looks like consecutive buy climaxes, maybe a parabolic wedge, 1, 2, 3, in a resistance zone. We sold off at this price yesterday. So even on the 15-minute chart, I would wait and not take that high one. What happens if it just keeps going straight up? I miss it, right? I miss stuff all the time. I never worry about, there are two ways to be dumb. One is to take a bad trade and stay in it. That's dumb. Another is to miss a good trade. I don't ever want to make the first kind where I do something stupid, but I don't mind missing something that turns out to be good. I can't lose money by not taking a trade that turns out to be good, but I'm always going to lose money if I take stupid trades. If you're starting out and you've been trading for a few months, you'll notice that you've had some pretty good trades, yet you're still losing money. And the reason why is because you're taking too many bad trades, or you're managing trades badly. And one of the most important things in transitioning from losing money to making money is getting rid of bad behaviors. So you have to choose trades better, and you have to manage trades better. One of the problems that beginners have is they tend to be so happy to get a profit that they take the profit right away. So they buy above 4, they get 2 points of profit, and they exit. Instead of thinking, wait a minute, we might get a measured move up based upon the size of those bodies. The open of 3 to the close of 4. Almost got there here. So, the beginners tend to be very quick to take profits because they're so happy to have any profit. However, if you're taking quick profits, you're scalping, and your reward is much less than your risk. The only way you can make a living doing that is if you're winning a very high percentage of your time, of your trades. And that means usually 70 or 80%, a good scalper will win 90%. But let's say 80% of the time, if you're a scalper, you have to be winning consistently 80% of the time to make a living as a trader. And somebody starting out is not going to win 80% of the time. And therefore, if they're scalping, they're going to lose money. So it's better, look for swing trades, and if the trade disappoints you, which it will, 50%, 60% of the time, just get out with a small profit or a small loss. But otherwise, hold on and try to get a swing profit, at least twice your risk. If you're going for a reward that's twice your risk, you only have to be right 40% of the time to make a living. And usually you'll be right more than 40% of the time. And if you trade well, you'll have some trades that are significantly more than twice your risk. So the reward is actually bigger than twice the risk. Probably a trading range for at least an hour, possibly for the rest of the day. So it might become a limit order market. If you get second reversals up, second reversals down, we might get some stop order trades. But 14, a doji bar, is usually a sign, even 7, 8, 9, it's a warning that the market might be transitioning into a trading range. When you have bars with big tails, small bodies, there's balance. The market thinks the price is fair. And that's usually an early sign of a market transitioning into a trading range. Bulls are hoping that the small pullback bull trend continues all day, but it's probably not going to. It's probably the start of a trading range, and the trading range could last all day. The bears are hoping that it's a bull trend and then a trend reversal, but a tight bull channel, the first reversal down, is minor. The bears know that. They'll try to get a second reversal down, a lower high, major trend reversal, 26, 27, 28, but that's still not very many bars down, not very many bars up. If we do reverse with a lower high 26, it's probably another minor reversal, like below 20 and above 24. So best choice right here, I think, is flat. We're always in long, but not a very good buy above 24, and a lower high, but probably a minor reversal. Not many bears willing to sell below a bull bar 25 after a big bull bar 24. So limit order traders will sell above things, sell more higher, take quick profits. Buy below things, buy more lower, and take quick profits. But most traders should just wait for a decent buy at the bottom, a decent sell at the top, and try to get 5 or 10 points. Big bear surprise. Bears trying to get a swing down to the 10 low. The more 27 closes on its low, the more likely we'll get about a measured move down. Measured move from what? Well, whenever I see a bear surprise bar breaking below a prior low, I'm thinking about a possible measured move based on the height of the range. And that would get us down to around that 10 low. Are we always in short yet? Not yet, but if the bears get 27 closing on its low and then a bear bar 28, then it could be always in short, and that would increase the chances that we get here. Remember, today is probably going to remain an inside day. Now, will bulls buy the close like they did 10 and 21 and 23? Or is this a big enough breakout so traders will sell the close? I'm not willing to sell the close, but if we get a second decent bear bar 28, then I might start to sell closes. We closed the gap above 6, and now we have 2 legs down, 1 pullback 2. I said that we probably would get a second leg down or sideways to down. Do I still think a trading range is more likely than a trend reversal? Yeah, it's a strong rally up to 19. And that makes it less likely that we're going to get a trend reversal. Now, I talked about how most likely we would enter a trading range, so a strong rally and then a trading range. I gave lots of examples. A common thing, less likely we'll have a strong rally and trend reversal. Sometimes it happens that you get a strong rally and then it's the high of the day. So spike up, parabolic wedge, and we just totally reverse the entire rally. This is what the bears are hoping will happen. A couple legs down, 1 pullback 2, but the bull trend does not resume. We go sideways and then we go down. Not nearly as strong a rally as today. First reversal down minor, but we formed a trading range, and then once in the trading range, we reversed into a trend. And that's typically what happens. You get a strong rally, and the first reversals are minor, and the market has to form a trading range before it can reverse. So bull trend transition into a trading range, and then the bears have a better chance of getting a reversal. Less often, you get a spike pullback channel, and it just reverses. And that's what the bears are hoping we're doing now. Breakout, not very good follow through for the bears, yet we could not get back above the moving average, and we kept on channeling down in an endless pullback. Spike pullback channel, 4 bear bars, and it just kept melting down. We only retraced about half of the bull trend. It's probably a minor reversal on a higher time frame, but spike pullback channel tested the start of the channel, which often happens. So I think we're still in a minor reversal down, but if we go sideways for a lot of bars, then the bears might get a major trend reversal, lower high major trend reversal. And what do you notice here? Bulls bought the close, right? You got a big bear bar, but still always in long, and strong rally. We're up to a magnet area, and the bulls expected to stay in that magnet area. So as soon as they saw that 27 bar, they said, wow, it's not going to be a reversal. and therefore it's a great brief opportunity to buy a sale. It's on the market's on sale. We'll buy. It's also we've been above the moving average for more than 20 bars. Traders have been willing to pay above an average price, and now they're finally getting an opportunity to buy down at the average price. Bulls are high 223, but I still think we're in a trading range, and that will be in a trading range possibly the remainder of the day. Can you buy above 28? High 2 at the moving average, 20 gap bar buy. That's a pretty good bear surprise bar, 27. The bulls are hoping 28 is like 11, but it's probably not. Remember I said I thought we entered a trading range on 14 or on 7, and I still think that's the case. So I'm not willing to buy above 28, but 28 is a reminder that the reversal is probably minor in the start of a trading range and not the start of a bear trend. If we go sideways for a few bars and form a micro double bottom, or a small double bottom, or a wedge with 23, 27, then I think bulls will be willing to buy with stop orders. And for the bears, what about the bears who sold the close of 27? Well, they made a mistake. The market's still always in long, and when you get a bear breakout, it's always better to wait to see if you have a follow-through bar. Bar 3, I said you could buy above 3, but it's better to wait to see if you get a bull follow-through bar 4 and then buy. And you can see 10. Why did 10 end right there? Because it was testing the 4 high, the 4 close. That's where the majority of traders decided the market went long. And so we tested that price. So high 223, 20 gap bar buy. If you buy, I think you need a wide stop. Surprise bar 27. Big enough bear bar will probably get a couple legs sideways to down. So if you buy above 28, you could put a stop below 28. You could use a wider stop. I did not buy above 28. I'm going to wait. If I were not talking, I probably would have bought the close of 27. I would have just instinctively just hit buy the market and then scalp out with 5 points. Bears are hoping this is an endless pullback. I showed examples of that where it's a pullback, but it just keeps pulling back. And at some point you decide it's not a pullback, it's a bear trend. Normally you want to see at least a couple decent sized bear bars with at least one totally below the moving average and both closing on their lows. That increases the chances that we are in a bear trend. And the bears did not get consecutive bear bars 27, 28. They'll need consecutive decent bear bars with at least one of them completely below the moving average for traders to conclude that this is the start of a bear trend and not just a leg in what will become a trading range. And you can see not a lot of buyers above 28 despite the high 2 and a 20 gap bar buy. And the reason for that is we're probably in a trading range. So lots of quick profit taking. What do you do right here? Well, you can see, are the stop entry traders making money or are the limit order traders making money? It's more the limit order traders. Big bear bar, 27, buy. Big bull bar, 28, sell more higher. Lower high, 29, buy below. All right, so it's limit order trading. We're still always in long, but it's all limit order scalping here. If you're swing trading, you're still on the buy above 28, stop below 28. But I think the trading range might last a couple of hours, might last all day. So I would not swing trade right now. And the range could be very tight. Several of those examples that I showed had very tight ranges, So really difficult to make significant money. Today's not looking as tight as that, but it could be like this. And Sometimes you get a little bounce that'll go more than just a bar or two. But I think best choice right here, just wait, and it's possible we'll have to wait for an hour or more before we get a good reversal up from the bottom to buy, or a good reversal down from the top to sell. But trading in here, unless you're a limit order scalper, a good limit order scalper, you're going to lose money. So it's better just to patiently wait. We had that strong rally and we were in an endless pullback. 41, 42, we had a bear breakout and bear follow through, and we got about a measure move down. The bulls tried to get a reversal up 55, but it turned out it was a bull trap and another lower high. And the next target is the low of the day and the open of the day. The bulls are hoping that we get a reversal up, trend resumption up. So bull trend starting yesterday's low, pull back, and they want trend resumption up. But they'll need a pretty good buy signal bar. I did not sell below 59 because of the two dojis. Can we get all the way down below yesterday's low? I still think, even though we've been selling off for 4 hours, I still think today's going to remain an inside day on the daily chart. So I think we're probably not going to go below yesterday's low, even though just below it is a very important price. Just below it is that December 20th higher low. That was the start of a very strong rally at the end of December. The bulls are hoping that this entire sell-off is simply a bull flag, a pullback from this rally. And the bears want to break below, and then they want to get below the December 3rd low, and then down to the October low. If we get below the December 3rd low, that's the low of December. December was an outside up month. January would then be an outside down month. We went above the December high here, and the bears want to get below the December low here. And that would be an 00, and it would increase the chances of lower prices in February and March. And the bulls obviously do not want that. Can you sell the market right here? I'm not going to. I'd rather sell rallies. We're fairly far below the moving average. And even though we're in a bear trend, it's not a very strong bear trend, so it's better to sell rallies. So the bulls, they're looking for a good buy signal bar. They had 150, but the tight trading range with magnets just below made it not a very good buy. And they'd like to get a good buy signal bar here, just at the open of the day. But the bears have been relentless now for 40 bars, and the bulls want a very strong buy signal bar. So if it's just a 3-tick bull body, I think a lot of the bulls will wait to see if we get a good bull bar on the following bar as well. Bears, I'd get out above any bull bar. I'd get out 2 or 3 points above a bear bar. It's pretty common for the market to have a trap around 11 o'clock, 10:30, 11:30, and this one was 11:05. By a trap, what I mean is a big trend bar, making traders think that a trend might be underway, and then the market reverses on the next bar or two and goes the opposite way, and possibly about a measured move down. So there's the top of it, there's the bottom of it, and we're right around a measured move. When you get those breakouts, 55, I always like to see a follow-through bar. And if you get a bear bar of 56, that's a warning that 55 might be a bull trap. We're up buying above 62 if it's a bull bar closing near its high. I don't know, it's probably not a great buy. It's probably better to wait to see if we stop going down, start to go sideways, and then form 2 or 3 bull bars, or wait to see if we get a bull surprise bar, a big bull bar closing on its high. And for the bears, I think they've flushed out, they've washed out all the bulls. So who's selling down here? Initially, during 57, it was the bulls from 55 who were selling, but they're pretty much done with selling, and therefore the bulls are not selling anymore, and you're left with bears. And do the bears want to sell this low? And for me, we got dojis 58, 59, tail 61, and we're far below the moving average, and we're right near a couple important magnets, low of the day and open of the day. So I'm a little hesitant to sell this far down. Just like up here, I didn't want to buy too close to the 60-minute moving average because it was important resistance. Okay, we're below the open, and now we're trying to get below the low. The bears would like to get down to yesterday's low. At this point, what are the chances that we get down below yesterday's low? I still think we will not, so maybe 40% chance that we do. The lower that we go, the higher the probability is that we'll get down below that blue line, that December 20th low. I don't know if you were watching, but 57 happened very quickly, and most of the selling took place in 1 minute. I'll turn this into a 1-minute chart. So right here, the market fell about 10 points, more than 10 points in just 1 minute. So real panic selling after the panic buying over there. It's still sell for any reason, but tail 61, 62, weak sell signal bar 59, and at the low of the day, and fairly far below the moving average. So right now, I am not selling closes. I'm looking to buy a reversal, or looking forward to stop going down, go sideways for a few bars, and maybe form a bear flag, preferably closer to the moving average. If the bears cannot get down below that blue line, the December 20th low, then you've got to wonder where the market will go at the end of the day. And when the day has a lot of trading range trading, and I would call it's a reversal day, but it's still a trading range day. A lot of times the open is a magnet at the end of the day. So right now, I suspect we're not going below yesterday's low, and that will end up closing around the open of the day, and that today will end up as a doji bar on the daily chart. Spike and parabolic wedge, 1, 2, and 3, but it still saw the close. I'm not selling because of the tails and because we're so far below the moving average. And the sell-off itself, it looks like just a reversal day, up and down. So we had a bull trend, we had a bear trend. But I don't call this a bear trend today. I call it a reversal day where we had both a bull trend and a bear trend. You know, the bear trend, while it reversed the entire bull trend, it did not go, at least not yet, did not go a lot lower. So I would not call it a bear trend day. I would call it a bear trend within a trading range day. But obviously, if we go down below yesterday's low, then I would call the whole day a bear trend day. This is a big rally. But if we go far below yesterday's low, this rally will end up being small. As I said, I still think we're going to remain in an inside day. So I think the odds of this collapsing the way we did yesterday, I don't know, 30%. Bulls are hoping that we do that this is the start of that. And bulls are hoping that we stabilize around these lows. We're a little bit below. They want to get a higher low major trend reversal. So very strong minor reversal up. And they're hoping this forms a higher low and that we get a second leg up. And the bears are hoping this is a double top. We break below the neckline and fall for a measured move down. Maybe some profit taking, low of the day, open of the day, a measured move down from the height of 57. So from the open of 57 to the close of 57, we're right around a measured move. I do not need two lines here. I think the open of the day is more important than the low of the day. So I'll get rid of the low of the day. Open of the day is important because if we close above it, the day will have a bull body. If we close below the open of the day and below the low of the day, the day has a bear body. But the key price, I think, is the open, not the low. Still solid close, and you can see limit order bears sold 63 high. Bulls did not want to buy 4 consecutive bear bars when it's always in short. They'll wait to see if we stop going down, start to go sideways, and then look to buy a second or third reversal up. Those tails that we're starting to get represent buying, and some of it is bull scalpers, but most of it is bears taking profits. They realize that we're far below the moving average, and we've had 5 or 6 bear bars. The bears have a big profit. We're around a measured move down. So they're looking for reasons to take a profit, and the location is good. Far below the moving average is good. So reasonable for bears to take profits. I would get out 2 or 3 points above a bear bar, 63. I'd get out 1 tick above a bull bar, maybe 64. And as for the bulls, do they buy above 64? That's not a great looking buy. It's good enough for bears to exit, but it's not good enough to attract a lot of buyers. If we get a bull surprise bar 65, then I think you'll start getting more buyers. In other words, if there's panic profit taking from the bears, if the bears suddenly decide this is the low of the day, we better buy back all of our shorts, and they get relentless buying during 65, creating a big bull bar, the bulls would see that, and they would conclude that the bears aggressively took profits and therefore probably are not going to look to short again for at least a few bars. So that would encourage bulls to buy, but they really need a big bull bar 65. They need a bull surprise. Do you have to get out above 64? Excuse me. I would. It's still a trading range today. When you look at the screen, okay, when you look at the screen, we had a bear trend, a bull trend, a bear trend, a bull trend, a bear trend. So you have to be assuming we're going to get another bull trend, and not that we're going to collapse from here. You can see not aggressive profit taking. And some bears, I personally, if I were still short, I'd get out above 64. And it's not good enough yet for me to buy. We might get stuck in this area for the remainder of the day. Might go up here, 58 high. We had a spike pullback channel, so there, moving average. I still do not think we're going to get down to that blue line. I think we're going to try to get a higher low major trend reversal, maybe on the 15-minute chart. So a big bear trend, pretty strong minor reversal, and it might take many sideways bars here to form a credible base, and then the bulls would like a second leg up. It'd be a head and shoulders bottom and a higher low major trend reversal. This is a 15-minute chart. The bears want a double top, break below the neckline, measure move down. At the moment, I think it's more likely we'll form the higher low major trend reversal attempt. I don't think we're going to go all that far up, even if we reverse. But right now, I'm trapped out. The market's deciding, is it going to go below the December low and form an outside down low? That would, I think, make it more likely than not that we'll trade down in February and March and down to the October low, maybe on that gap on the monthly chart back above March last year, around 4,000. a low one, but a doji bar, a bull bar, and several bars with tails far below the moving average. Might be more buyers than sellers here. So I'm waiting. I'm not taking the short. I'm willing to sell closer to the moving average, or if we accelerate down, which is unlikely, and I'm willing to buy, but I need better than 64. A high 2, 66, 64, but a bear bar and a tight trading range. Doji's 64, 65. So it might be more limit order buying 65 low, buying 64 low, and fewer traders willing to buy with the stop. And for the bears, it's a low one below 65, below 66, but fairly far below the moving average. I'm not opposed to taking it. I'm not taking it. The bears who are taking it are taking a chance that will come down here, fall 20 points. So they risk 10 points to make 20 points. If 67 remains an inside bar and closes near its high, it's a more reliable buy. First target moving average, 58 low breakout point, and then 59 high, the start of the channel. Spike down, pullback channel. Typically, you'll get a rally that comes back to around the start of the channel, and you form a trading range. And for the bears, they're trying to get down here. The market's paying attention to that December 20th low, but I still think that's a minor higher low. Here's the daily chart. We went below the January 10th low. I think we'll get below that. This is the important price, the December 3rd low. If we get below it in January, and I think there's, I don't know, a 50-50 chance that we will, that will create a consecutive outside bar pattern on the monthly chart. And then if February goes below January, that would trigger the 00 sell, and we probably then would trade down below October into that gap. Monthly chart. Very difficult to see, but there's a gap between the March last year high and the April low. And it's right around 4,000, just below 4,000. And I think 4,000 and that gap are magnets below. So if we do get outside down here, it'll be the second consecutive 00. We had one here with a bull bar and we went up. If we have one again here, it'll be with a bear bar and a micro wedge, 1, 2, 3 monthly chart. And we'll probably get a measured move down, which would be to the October low and in the neighborhood of that gap. That's where I think we might be headed. Outside down, but tail. So it's still a bear trend, but traders are being forced to sell far below the moving average when we're getting tails and now a bull bar. So that increases the risk that you'll be selling at the low. When you start to get tails and bull bars, the market might be transitioning into a trading range, which means that if you're selling at the low of the move, you might be selling at the low of the trading range. The closer it gets, the more likely we're going to go below that December low. So right now, I think we're probably going to go down there. What will happen when we break below it? Will we collapse, or will there be buyers there? I think we're not going to collapse. I think there'll probably be buyers who will probably bounce again. Here's a 15-minute chart. So the bears want double top neckline and measured move down, which would get us very close to that. Let me do it this way. That target, the December low. Okay, that's 15-minute chart. Here's a 60-minute chart. Put up a 4-hour chart. Here's a 4-hour chart. Here's the measured move. and it's below that December low. So if this double top bear flag does go for a measured move down, it will be below the December low, and the result will be we'll have an outside bar in January, which is looking increasingly likely. There's a surprise bar just above really important targets. I'm letting it go. I did not sell below 66 or 65. That's where, if I were selling, that's where I would have sold, and I did not do it. So right now I'm trapped out. So what happens at the December 20th low? Do we collapse? Well, we're already collapsing from here to here. So I suspect we're not going to collapse much more. The bulls are hoping we get a double bottom with yesterday's low and that we reverse up. But the momentum down is very good. So at this moment, it's obviously more likely that we'll get below the blue line. Sometimes you'll get very strong sell-off similar to this, right down to yesterday's low or some other major support. And rather than breaking below, the market reverses up strongly. So this is something to keep in mind, that even though it's strongly bearish right now, it doesn't necessarily have to break below that support. This could be another test of the support, and we could get an abrupt reversal up. But the bulls need a very good buy signal bar. So sometimes the market will collapse down to just above yesterday's low, and then reverse up. This is what the bulls are hoping, that it's just a self-vacuum test of yesterday's low, and that we do that. But that December 20th low is so important. Okay, we just dipped below yesterday's low, but not below that December 20th low. I think we're probably going to go below the December 20th low. But this is so extreme that I think we'll probably get profit taking and try to get back to the open of the day by the end of the day. Bulls want a bull bar, 70, right? If it's a bull bar closing on its high, it's a credible swing buy for a test back up to the open of the day. Even though the bear trend is very strong, this could be one of those sell vacuum tests of a prior day's low, and the test is successful. The market does not fall below the low and instead reverses up. But the bulls will want a good buy signal bar, 70. So you want that, a bull bar closing near its high. Another example, just above yesterday's low, you want a very strong sell-off. You want a bull bar closing near its high, or you'll wait for a second bull bar and then buy. Yesterday's low, big bull bar, 2 bull bars. Testing yesterday's low, bull bar closing near its high. Same thing, sold off for several hours, and then right above yesterday's low, we got a pretty good bull bar. Now, every example that I'm showing you, you see a really good bull bar. So if we don't get a really good bull bar, I don't want to buy, because the reversals that I'm showing you are reversals that go up quite a ways, and all of them have bull bars closing near their highs. This is not perfect, but I would still take it, a wedge. You could wait for a pair of bull bars closing near their highs and hope that we get a big reversal up. We're running out of time. Same thing here. Not a great bull bar, so some traders will wait for a second bull bar. That would be higher probability. What's different today compared to all these examples I'm showing you is today is much earlier in the day. It's much later in the day. So here, tested yesterday's low. We have a bull bar. So theoretically, it's a buy, but there's really not much profit potential remaining in the day. So that's not great. Bull bar. Some traders will wait for bull bar closing near its high and then buy. It's the middle of the day, so you have a lot of time left to get a lot of profit. But when the reversal takes place late in the day like this in the final hour, you're probably not going to get much profit. So this is an example of late in the day. There's very little room between yesterday's low and the December 20th low, but the market dipped into that space and is trying to reverse. Now, bears, I'd get out above any bull bar, okay? And for the bulls, if you take the buy, you got to be trading it for a swing up. You got to be betting that we're going to come up to the most recent sell climax high up here, moving average, open of the day, right? So you don't take it and scalp out for 2 points. The bar is big, it's 8 points big, so that's $400 per A-mini contract. The bears see what's going on, and they don't want the market to go above 70 because if it does, 2 things will happen. A lot of bears will buy back shorts at the end of the day, and a lot of bulls will buy, and the market will probably go up. So the bears are selling the close of 70, trying to prevent 71 from triggering the buy signal. Testing it again, okay? We're right at that January 20th low. Bears are trying to get below it. Will it collapse or will it reverse? I do not think it'll collapse, but I'm not sure that it will reverse either. Target above open of the day and the start of the most recent sell climax. We had a sell climax here. We got to the start of the climax on today's open. We have enough time remaining in the day so that the bulls might be able to get back here. Can you just buy at the market and put a stop 1 tick below the blue line? So you're only risking a few ticks? Well, whenever your risk is small and your reward is big, what's your probability? Probability is always small. Whenever you have fantastic risk reward, you always have low probability. And that means if you buy right here at the market and put a stop 1 tick or 2 ticks below the blue line, you're probably going to get stopped out. Everything is so compressed. I want to see, okay, we did not even reach the blue line. You can see we're still above the blue line. Okay, see how we plunged below it? So anybody who sold with a stop 1 tick below the blue line probably had slippage. Might be just a tick or two. They may have had a point or two slippage. It was a pretty good plunge below that December 20th low. It's still a small pullback bear trend, right? This might turn out to be a measuring gap. 57 was such a surprise that it may not have simply led to a measured move based on the height of the bar. It might be leading to a measured move based upon the whole upper range. Okay, we're already beyond that. I did not do anything here. I did not sell. So right now I'm trapped out. I'd like to sell a rally, but by the time we get a rally, the day will be almost over. And I'd like to buy. I had an order to buy above 70, and I just canceled it now. So now I'm waiting again. In some trends, it's difficult to structure a trade. You see the market going down, and the momentum down will probably take it at least a little bit further. But the bars are big, so the stop is far away, the risk is big, and you're very far from the moving average, and it's a sell climax, and there's a risk of a sharp reversal up. When I was younger, I used to sell, and I was very quick at getting out. But now that I'm older and lazier, I don't like to sell at the bottom of a sell climax. I prefer to sell pullbacks. I said that the next target, the really important target, is the December low right here. And that's probably too far below where we are. Right now it's about 25, 30 points below, but that's the real target. That's where I think the market is headed, because then January would be outside down, and it would be a sell signal bar for February. February does not have to trigger the sell. It does not have to go below the January low. However, with the micro wedge on the monthly chart, I think if January is outside down, February will trade below January and will fall for about a measured move based upon the height of the 00, which is the height of January's range, and that would get us down to around that October low and that gap around 4,000. On the news tonight, they're going to say the E-mini fell 10 points, or the S&P fell 10 points today. And that's true. We're only about 10 points below yesterday's close, but it misses the point that we actually sold off 80 points from the high of the day. Bulls still okay to buy above 72 if it is a bull bar closing near its high and has more than just a two-tick bull body. And for the bears, I'd get out above any bull bar. I'd get out 2 or 3 points above a bear bar. If 72 is a bull bar, but the body is small, some bulls will wait to see if 73 is a better bull bar, and then they'll buy above that. The bears will try to prevent a reversal. They'll try to prevent 73 from going above 72. The way they were successful with 70, they prevented 71 from going above 70. Now, if you're a bear and you've sold the close of 71, what are you doing right now? You're thinking, oh, I don't know, it's back to where I sold. Maybe I'll get out. So just the size of the bounce is enough to make a lot of the late bears buy back shorts. If enough do, 72 could end up as a bull bar. This is the end of the 6th hour, and right now the hour is a big bear bar, and it closed below the December 20th low, good for the bears. So I would not buy above 72. If 73 is a big bull bar closing near its high, I might buy above that. Daily chart, 50-day moving average, the red one is the 100, and now we're getting near the 150-day. And the most important price is that one right there, that December 3rd low. If we get below that, January is outside down after December was outside up. Weekly chart, the bears are trying to get as far below the bull channel as they can. They'd like to get below the December low. Maybe we'll fall for a measured move, which will get us down to around that October low. Can you put up a 1-minute chart and take early entry buys? I think that's dangerous because, yeah, the risk is less, but the probability is less, and the probability of making mistakes is greater because you have less time. Mistakes is greater because you have less time. Is there still enough time for the market to get back to the open of the day? Sure. It took us about a half hour to get down here. If we raced up, we could get back there. Bears are trying to get the day to close on its low. Still, sell the market, sell the close, sell for any reason. But the more parabolic we fall, the more likely we're going to get a sharp profit-taking bounce at the end of the day, especially since we had a strong rally early in the day. This increases the chances that the bulls will be willing to buy again later in the day. What about selling the market, but selling a small position and selling more lower? I sometimes will do that also. A lot of times if a trade is not perfect, if the math is not great, I'll sell, and then if it goes down, sell more. If it goes down, sell more, and then build a position that way. Testing the 4,500 big round number. and the December low. A lot of times when you have a major support level and it's on the screen and it looks like it's too far to get there, the market will get there at the end of the day. That's what took place yesterday. At this point, it looked like that December 20th low was out of reach given we had less than an hour to go. But then we accelerated down almost all the way there. And the bears are hoping they'll be able to do the same thing here and break below that December low. It's still sell for any reason, right? So if you have the ability to make quick decisions, you can sell. I'm currently flat. I'm letting it go. But bears, I'd get out 3 points, 4 points, 5 points above any bear bar, just in case we get a really big reversal up. And I'd get out 1 tick above any bull bar. So it's becoming increasingly likely that we're going to get down here or very close to it today. How much of this has to do with Russia? I think Russia is providing the fuel for the market to do what it was going to do anyway. And that's correct in the first half of the year. But if you think about it, Russia threatening Ukraine creates a bigger problem for Europe than it does for the United States. You know, if they invade Ukraine, what's stopping them from invading Estonia or Latvia or Lithuania, right? And then what about Poland? So it's a bigger problem for Europe than it is for the United States. And that would probably make the euro weaker relative to the dollar. So the euro versus the dollar would probably go down. Gold probably would go up. And you would think that if Bitcoin really is a store of value, that there would be a flight to Bitcoin as well. But so far, it's not happening. Here's a daily chart. Here's gold. Gold is starting to rally. Not all that impressive. And it's not what I want. I got to change this around. This is messed up. Anyway, that's gold. I'll put up GBTC. This is an ETF for Bitcoin. And despite the problems in Russia, we're not getting strong buying. So the market is not seeing Bitcoin as the same kind of store of value as it does gold. Let me see what other things I have up here. Daily chart. This is BITO, which is an ETF for Bitcoin, and this is the GBTC. But you know, not a lot of people panicking into buying Bitcoin. You got a little bit buying gold, and obviously a lot buying oil and anything oil related. This is crude oil. And check bonds. They started to turn up yesterday. So you get some, even though the bonds are collapsing, you get some buying going on here. Bond market, you've probably seen the high. This is the monthly chart. of your lifetime. The bonds are never going to go back here again in your trading career. I've been talking about a major bond top. We tried to top out here, then we get a parabolic wedge here, and I think this is going to be the final high, and that we'll get down here. No one's talking about interest rates, 3%, 4%, 5%. Well, that's probably what's going to come in the next several years. So we'll probably get down here, and I don't know what interest rate that would be, but it probably would be at least 3%, 4%, and bull channel, bear flag. So you'd expect the market to trade down here, maybe bounce for a few years, and then head and shoulders top, left shoulder head, right shoulder, and then maybe come down here and start to get 6 or 7% interest rates. So I think that is our future. We already have a head and shoulders top here, left shoulder head, right shoulder, but you can go sideways for years. This is a monthly chart, so we could easily go sideways for 5 or 10 years before we get down here or down here. But that is where the market is headed. I started talking about that all through here, that the bond market was either forming the high for the rest of your career, or we'd get one more push up, and then that would be the high for the rest of your trading career. Trends in the bond market tend to last 20 years, 30 years. We've been rallying now for about 30 years. So we're probably going to go sideways to down for 10 or 20 years. At a minimum, we'll get down here. And if you start to get up here again, interest rates go to 0. And I just don't think that's going to happen. I think interest rates are going to go up and a lot higher than what anyone is saying. If you remember, I don't know if you read the stuff that I wrote last year. I said that Powell was lying. He was saying that he would not raise rates until 2023, and I said that's clearly a lie. The bond chart doesn't believe it. The bond market doesn't believe it. The bond market is in a bear trend, so interest rates are going up. Yes, the Fed only controls short-term interest rates, but they raised short-term rates to try to prevent long-term rates from getting too high. And so I said, the bond chart has topped out, and it's a pretty credible top, and interest rates are going up. And for Powell to say he's not going to raise rates for 2 or 3 years, he's just lying. He has to, he looks at everything. He has to look at the bond chart, and he's not stupid. So he had to know that interest rates were going up, and there was nothing he could do to stop it. And for him to say he was not going to raise rates until 2023 had to be a lie. Now he's talking about 3 interest rate hikes this year, but maybe 4 or 5. And, that's part of the fundamental reason why the stock market is selling off. Okay, a low one and a really important price just below. Bars are big, so if you trade, you have to trade very small. I said earlier at this point that the day was still a trading range day, and that for it to be a bear trend day, the market would have to get far below the open. Well, look at the daily chart. It's now a bear day, a bear trend day. Sometimes when you have a strong bull trend like that, it'll fall for about a measured move based upon the height of that big bull trend. And at the end of the day, the big bull trend will not be a big bull trend anymore. It'll be small relative to the sell-off that followed. So there's a measured move down, and we're very close to a measured move down based on the height of the bull trend. Am I still willing to buy if we get a good bull bar? We would need a very good bull bar closing very close to its high. And even then, if we reverse up, are we going to get up here? No. If we reverse up this late in the day, it'll probably be just a couple bars. It'll probably be like this, a couple bars up, and then boom. So if you're buying in a sell climax this late in the day, you've got to be taking really quick profits, because there's probably not much profit to be made. You don't hear anybody talking about the December low or read about anybody, but everybody's aware of it, and that's why we're doing what we're doing, right? All the institutions know how important that December low is, and that's why we're selling relentlessly down to test it. You also do not hear anybody talking about a crash. can this be the start of a stock market crash? This is the daily chart. Crashes are rare. Look at where we are. We're at the bottom of a 3-month trading range. So it's still more likely that if we go below this December low, we'll bounce than it is that we'll go straight down. Here's the October low. That's the other target. But, would I be surprised if we just collapse? Not at all. There's pretty much nothing at this point. There is nothing at this point that surprises me. Excuse me. By the way, I started trading before the 1987 crash, and I was trading during the financial crisis. And I've traded during pretty much every big crash since 1929. Obviously, I didn't trade in 1929, but there really hasn't been crashes between 1929 and 1987, at least not the way we have them now. Here are some crashes on the 5-minute chart. Similar to today, a big rally, relatively big rally, endless pullback, and then we just crash at the end of the day. Or crash in the second half of the day. Huge reversal up, but it was minor. We ended up going back down lower. On the daily chart, a big bear surprise. We got a second leg down before we got a reversal. Here, this is the flash crash in 2010. This was a really big deal in 2010. The market fell 9% in 25 minutes. So 9% would be 400 points in a half hour, right? And yet the market reversed. Difficult to trade. If you sell, you got to be really quick to get out. When you get these crashes, you call your broker and say, "What happened? Why couldn't I place orders?" What happens is when you get these crashes, the brokerage firms, the retail brokerage firms, get overwhelmed, and a lot of times they'll lock up, and you cannot place orders. So if you're short, you can't buy back your shorts. If you're long, you can't get out of longs. And every time one of these crashes happen, the industry and the firms do things to say, we're not going to let this happen again. And they're correct. It won't be the same crash next time. So they prevented the last crash, but not the next crash. There'll be something different about it that makes it very difficult to trade it. This was an 82 point fall. This is the crash during the financial crisis. Back then, 82 points was about more than 10%. And this was the 1987 crash. It shows bounces, and I don't know if there actually were bounces, but the market fell 21% in a day. On this day, I had a full surgery schedule. This is back in '87. I was short 13 S&P contracts, so it's like 85 E-mini contracts. And the market bounced a little on the open. You don't see it, but it did bounce a little on the open, and I had to go to the office. So I had to buy back all of my shorts, and I missed out on the crash. And had I held, I would have made over $1 million that day. Below the December low. All right, so now January is outside down after December was outside up. And February probably will go below the January low. That will trigger the 00 sell signal, and that should get us down to the October low. We obviously do not have to stop at the October low. We have that gap down there. below, above the March 2021 high. That's a magnet, a gap on the monthly chart. That would be about a 20% correction. And I've been saying that I think that's probably the worst that we'll get this year. What happens if it's more? I don't, it won't bother me at all. Here's the daily chart. So a 20% correction is somewhere down here around this gap. We're getting close to a 10% correction. 10% is probably somewhere around here. But this is pretty much the worst case, 3,800, 3,900. Well, what about buying now? No, I think you just wait for tomorrow and see what we get. Whenever the market falls below an important price on a higher time frame chart, in this case the December 3rd low, the bottom of the 3-month trading range, it tends to pull back above that price, and then it tends to break below it a second time. The bulls will try to get a second reversal up. If they're successful, they can get a swing up. But if they're unsuccessful, if they get a second, if there's a second break below that price and the bulls do not get the reversal, the market will try to fall for about a measure move down, which would get us down to around that October low. Anyway, I'm not wild about missing the market falling 100 points in an hour and a half, but I ended up missing it. If I were not talking when I've traded it, I don't know, I probably would have traded a very small position and added on. Anyway, today is one of those days, which was 2 days. There was what took place for the first 5 hours, and then what took place over the final hour and a half or so, 2 hours. Yesterday was a dramatic sell climax day, but it stopped just below a higher low on the daily chart, and we had a big gap up. The day after a sell climax day, you have a 75% chance of the market trading sideways to up for at least a couple of hours. And it usually starts, starting before the end of the second hour. Sometimes it begins right on the open, and today it began on the open. Bar 2, a bear inside bar, not a very good high 1 buy, or a reversal up, big down, big up. Bulls should get a couple legs up. The bulls will buy the first sell up, trying to get a higher low major trend reversal. I thought 10 was not enough of a sell up. I thought we'd get a bigger sell up, like 10, 15 bars, which we did, but we never resumed up. Instead, we got the reversal down. For stop entry traders, I would not buy above 2 or 1. 3 was a big enough bull surprise. I think buying above 3 was okay. If you want higher probability, you wait to see if 4 is a bull bar, and then buy above 4. And then 5, tail, 6 tail, both are probably by the close. You can always get up below bear bar 7. The bulls got a bull bar 11 for a high 1. 10 was an attempt to break out. It closed below 9 and it closed on its low, but we had a 7-bar bull microchannel, every low at or above the prior bar's low. And I said there might be more traders buying the close of 10 than selling the close. So some traders bought above 11, some waited for a second bull bar 12, and then a whole bunch of traders bought above 12. You can see that on 13. We had a high 1 on 14, but we might be getting a wedge with 6 and 13, and the market might stall around the 60-minute moving average. So I think the math is not as good buying above 14. Another breakout, 16, and now you're going to be thinking maybe the parabolic wedge is 13, 16, and then one more leg up. The bears try to get a reversal down 17, but there were 8 bars without, or 7 bars without a bear body. I'm not going to sell below a bull bar, even though we're at my resistance zone. Yesterday's 41 high, 42 high, and the 60-minute moving average. I said I thought the market would have a hard time going much above that resistance, and I said we probably would end up going sideways, maybe an hour, maybe the rest of the day. The first reversal down, despite the parabolic wedge, 13-16 or 13-17, 19 is probably going to be minor. but it's reasonable to sell below 20. We might get a couple legs sideways to down. Bulls trying to get micro double bottom 2123, but a bull bar 24. I thought we would get a lower high in the second leg down, and the bears got a big bear bar 27, but I thought it might be like 10, another bear trap by the close. It's also a 20 gap bar buy signal. We've had a gap between the low of the bar and the moving average for 20 bars or so. Traders have been paying above the average price, and now they're finally getting an opportunity to buy at the average price. So there will be bulls buying with a limit order at the moving average at the 23 low and at the close of 27. Now we have a high 228, but a bear surprise bar, so we should get a second leg sideways to down. So I'd like to see a strong reversal up above 28, and then I'll buy. Right now, I think we're probably going to be in a trading range for at least an hour or two. Once it's in a trading range, the bears will try to get a lower high major trend reversal, and the bulls will try to get a wedge bull flag or a double bottom bull flag and trend resumption up. But as I said, I thought today would remain an inside day and not go above yesterday's high. Tight trading range, a low 2, 31.29, but 4 bars without a bear body. I'm not going to sell that. And then the bulls got a wedge bull flag, 34. 3 legs down, 23.27. Possible over the day, but a tight trading range, 60-minute moving average just above. It's probably going to be a minor reversal up. And then we got another low 2, 39, 37.39. It's a lower high double top, 30. The bears want to break out below the wedge, 35, and a measure move down. And the bulls hope that if we pull back below 39, we'll get a higher low, and then we'll start to get a series of higher lows and a bull trend. But not a very good sell. We're in a bear trend right now from bar 19, lower high, lower high, lower high, low, lower low, lower low. But we're also in a trading range, and right now it's a low probability sell. If you want to sell, you could wait and sell below a bear bar 40, or you could wait to see if we get a pair of bear bars closing below the moving average, with one being big and closing there slow. 41, breaking below the wedge, 35. But can the bears get follow through? If they do, then it's always in short and sell the close. And they did. Sold off several bars. The bulls are hoping double bottom 10, but now we have 5 consecutive bear bars, so probably sellers above. A low 145, but a bull bar. I don't want to sell that. A high 247, but 2 bear bars. I don't want to buy that. Bulls double bottom 50, 46, and a bull bar. Maybe you can buy that. For the bears, a double top bear flag, 48, 51. Probably a minor reversal. And then 52 is interesting. It's hard to see, but the low of 52 is 1 tick above the low of 50. So we have a double bottom 46, 49, and a pullback to a higher low of 50. So if we get a bull bar on 53, it's a credible buy. And for the bears, we have a double top pullback, double top 48, 51, pullback 53, but a bull bar. It's not quite a ledge. A ledge is a tight trading range with 4 or more bars with identical highs or lows. And the 52 low is 1 tick above the other 3 lows, 46, 49, and 50. So it's not exactly a ledge. Bears getting a breakout 55, but I'd like to see a breakout and follow through before selling at the bottom of a tight trading range. And then the bulls got big bull surprise bar 55, breaking out above the top of the range after a failed breakout below the bottom of the range. And it's possible that we'll get trend resumption up here. But whenever we get these breakouts, I always want to see the follow through bar. I'd like to see a second consecutive bull bar and then buy. Because if there is a bear bar right after the bull bar, then you got to be thinking this might be a bull trap, and there might be more sellers below that bear bar than buyers. And then we had a bear bar 56. So that's a problem for the bulls. If you're long, I'd get out below 56. And if you're aggressive bear, you could sell below 56. And as a tail, you could wait for one more bear bar. And then we had that exceptional bear bar of 57. It looks like we're probably going lower, maybe down to the open of the day. Bad follow through 58. And for the 59, bad follow through again. At least this one's a bear bar. Not a great low one on 59. If you're selling, you're looking for a measure move down. Maybe based upon the height of this tight range, maybe based upon the height of that bar. Less likely based upon all of this. And that's what we ended up getting. Bear bar 60, so it looks like it's becoming sell to close. 61, bear follow through, sell to close, but tails might be a spike in channel. So it might be spike, bounce, and then micro wedge down here. Excuse me, but 64 is not good enough for me to buy above it. It has a fairly conspicuous tail, and we have 5 bear bars. So bears might get out above 64, but they'll then sell again below a bear bar, maybe 65, or below the 64 low. Low 165, it's a doji bar. I'm not willing to sell. We might be forming a tight trading range. 66, the bear bar closing there is low. So if you're trading always in, you'd sell below 66, or now 68. A bear bar closing there is low. 3 consecutive bear bars. The bear body's getting bigger. So it looks like we're going lower. There may be fires below at that December 20th low, the blue line, and yesterday's low. And you can see on 70, there were buyers. We have a bull bar. Parabolic wedge, 58.64, good bull bar on 70. Because of the possibility of this being a sell vacuum test of support, it's reasonable to buy above 70, put a stop below 70. But the bears will sell the 70 close, trying to prevent the buy from triggering. And they're hoping we go lower. I think at this point that we're probably not going to get down to the next important price, which is that December low, the December 3rd low. But in fact, we did. Sell the closed bears, big bear bar closing on its low, breaking below the blue line, and a bear follow through bar. So now it's sell the close, and it was sell the close all the way down. And we did, in fact, get below that December low. So now, on the monthly chart, January is outside down. It went above the December high and below the December low. And December was outside up. So January is a sell signal bar on the monthly chart. If February goes below the January low, it'll trigger the 00 sell signal. There's also a micro wedge on the monthly chart. And January is the sell signal bar. So if February goes below January, it would also trigger the micro wedge sell. And we'd probably get down to the start of the micro wedge, which is the October low, which is where we're probably headed right now. Stop entry traders today, let me break it into 2 days. You can buy about 3 or 4, and then buy the close 5 and 6. I'd get out of longs below 7, possible buy climax and reversal, but I would not short. I would buy again above 11 or 12. 14, third leg up, so risk of a wedge top is greater. And 18, I would definitely not buy above that. There might be sellers above. 20, parabolic wedge. 13, 17, bear bar, spike and channel up, spike, pullback channel at resistance. Yesterday's high, or yesterday's lower high, 42 high over there, and then the 60-minute moving average. Probably we're going to be sideways here for an hour or 2, possibly the rest of the day. You should get a couple legs down, so you could sell below 20. If you're still short on 23, 24, okay to exit. I would not buy above 24. 28, it's a high 2, a 20 gap bar buy, but a big bear surprise 27, so I'd wait for a second buy and buy above 35, which was also a wedge, 23, 27. But I would get out either below a bear bar 38 or a second reversal down 37, or a possible double top, lower high major trend reversal, double top 30. And to short, either sell below 40 for the double top, lower high major trend reversal, or wait for consecutive bear bars, one being big, closing there slow, 41 and breaking below 35, or wait for the follow through bar 42 and then sell the market. Breakout 43, you could sell below 43. 45, you could sell below it, but you're probably going to be disappointed. But the tail 46, you can get out, place a limit order to get out around break even. 50, I personally did not buy above 50, and I did not sell below 51. And we got the bull breakout 54, but let's see the follow through. And it's a sell either below. We never had the bull follow through, so it's not really a buy above 55. If you bought above 55, you're disappointed at 56. You're placing a limit order to get out around break even 57. And you can see everybody just sold 57. Bull sold, bear sold. You could sell at the market during 57, or you could sell below the low of the bar. You can wait for the low one, 59. Better to sell below bear bar 60. And it probably was clearly, again, always in short 57. Always in short, maybe 42. And I don't think it ever went always in long, but the bears, I think, made it always in short again, 57. And then down here, it's sell to close, or sell below bars, sell below 66, sell below 60, sell the closes of the bear bars, sell below 63, but it's a parabolic wedge. I would not. Bears could sell below 66 if they get out above 64, and it was sell the market, sell the close all the way down. 70 is interesting. The buy did not trigger, and therefore it's still a sell. The bears were still short, and they could either sell below 70 or 71. And we just got drawn, sucked all the way down in a crash. I would call this a crash. No one's going to call it a crash. I'm calling it a crash. Crash to me is just a technical thing. It's just a big sell-off, a rare thing. This is the kind of thing you see, once every few years, and it's just a series of big bear bars in a micro channel without much buying. I'm losing my voice. Limit order traders, you could buy the 7 low after a 7 bar bull micro channel and a bad sell signal bar. You could probably sell the 18 high. You could probably sell the 23 high. Excuse me. You could probably buy the 37 low, sell the 44 high. And then in here, the range is so tight, I think it's better not to do anything. You could sell the 63 high and then get out above the bull bar 64. And then there was no other limit order trading. It was just a crash on the way down. We're below the December low, the other chart. Is tomorrow going to be a follow-through bar? We've been in a trading range for 3 months. Tomorrow is probably not going to be a big bear day. But even if it's a small bear day, or if the next day is a bear day, that would be follow-through. And it would increase the chances of us going down to the October low. The bulls need a pretty dramatic reversal up tomorrow or Monday for this to simply be a failed breakout below the trading range, expanding triangle. Down, up, more down, more up, more down. And they'll probably need at least a micro double bottom like this. Right now, it's more likely that we're going lower, but tomorrow is important. Even a small bear body tomorrow will increase the chances that we're going to fall for a measured move, which would be below the October low. Now, if you talk about any trades that you took today and how you manage the swing trades, on the open, I thought the rally was going to be a bull leg in a trading range, and then it would stall around the 60-minute high and yesterday's 42 high. I think I bought the market around the close of 4, and I don't remember if I got 10 points on it or not. And then where else did I buy? I might have bought during 13. Sometimes I just buy at the market as the bar is forming, and then the bar doesn't look like it did at the time I bought. So I don't remember if I bought during 13. I sold below 20. I took part off at 5 points and then took the rest off. I don't remember how many points. And then in here, I bought above 35, and I don't remember. I don't remember what I did. I got out probably during 38. And then here, I think I sold the close of 44. Disappointed by this, and I got out around break even somewhere in there. And then in here, I think I sold the close of 58 and took quick profits somewhere in here, thinking that 10 points was pretty good. But 10 points is not nearly as good as 100 points, which is about what I would have had if I held long. When I'm talking, I tend to trade differently from when I'm not talking because I can concentrate. And for me, I really like to concentrate, and I don't like distractions. And talking it's a distraction. Okay, question: how do you decide whether to take a strong breakout bar as it's forming versus waiting for a pullback or concluding that you're trapped out? Context is the number one thing. If I think the market is going up, and the breakout bar is far above some breakout point, I'll often buy at the market. Otherwise, I'll wait for the bar to close and buy the market on the close of the bar or with a stop above the high. Or I'll wait for one more bull bar, like 4, and buy the market or buy above its high. And if the risk is too big, then I just use the appropriate stop, but trade small, and then I can add on higher as it goes up, and the opposite's true on the way down. In situations like this, I really do like to sell and sell more lower, and I just missed the entire thing today because I felt like no matter what I did, I would have to make decisions, and I don't want to be talking and making decisions. But ideally, what I would have done is trade small. Let me give the example of if you normally trade 1 E-mini, your small size is 2 micro E-minis. So I would have sold the close of any bar, like 60 or at the market, get on above 64, and then sell below 66, and then take as many of the additional sells as I felt like taking. Sell the close 67, sell the close 68, 69, did not get above 70, so I'm still short, and then just keep selling all the way down and using a tight stop. Maybe 3 points or 5 points above a bear bar and 1 tick above a bull bar. And this was one of those unusual days when that kind of strategy would have resulted in a huge profit without much risk, because even though you keep adding on, your stop is always tight on the entire position. So even if your stop gets hit, you're not going to lose at least much. You're not going to lose very much. Okay, question. Is it at least 60% probability if you buy the 65 low to make one, okay, hang on a second. Is it at least 60% certain if you buy the 65 low and risk 5 points to make 1 times risk if you're quick to get out? So you buy the 65 low and risk 5 points to make 5 points. I would not say that was 60% probability because of this is what the market looked like. And so if you bought that low, it turns out it looks like you probably would have made the 5 points. But if I'm buying in a strong bear trend, I want to see better bull bars than 64 or 65. So for me, I would not be ready to start buying with limit orders yet, because there's always the risk that you get something crazy. Again, this is the kind of thing that you'll see once every few years. We're not going to see something like this again for several years, where the market falls on whatever it is, how many percent, 2%, in an hour and a half or so. All right, I'm losing my voice. It's a sell climax day, so tomorrow should have at least a couple hours of sideways to up trading, and the bears have already achieved their goal. Yes, they would like the market to continue to collapse down to the October low, and it might. I suspect tomorrow we'll have at least a small bear body. If it has a bull body, it probably will be a small bull body. And I think we're probably going lower. But we're really very oversold and we're at the bottom of a trading range. So I would not be surprised if we bounce for 2 or 3 days. Right now, the big issue is, do we get a second close below here? If we do, traders will start to think about a measured move down to 4,000. Okay, hope everybody has a good night.